You don't have to spend hundreds of dollars to trade options. In fact, you can do it for less than 100. Keep watching this video. Hey, what's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks. And in this video, we're gonna talk about low priced options. If you wanna start trading options, but you can't afford to risk a lot of money, or if you have a smaller account and you just wanna build it up, I found that there are ways that you can get in with low risk and still make more profit than most people who trade higher priced options.
How much?
What are the actual steps to finding and trading options for $100 or less? So you're gonna see a few basic strategies showing you how you can start trading options with just a few dollars in your portfolio, all while limiting the risk. Let's just start here. The first thing that you're gonna wanna do is develop a strategy. And that can include directional option strategies as well as neutral strategies. I mean, the stock is only going to do one of two things. It's either gonna be in a trend or it's going to range, and that's trading sideways. So you only need one or two strategies that work in either trends, ranges, or both. So here's a list of 3 basic strategies that you can choose from right out the gate. So you have breakouts, pullbacks, and reversals. And each one is going to have different setups. But once you've started looking at the stock chart and you found the overall trend, okay, you've started further away, then you can start to get an idea of the market direction, and that's gonna help you start the option picking process. So you can anticipate stock price movements in different ways, like support and resistance, stock indicator signals, overbought, oversold, and also Fibonacci levels. So there's a few different ways that you can pick and choose your entry and exit positions. To actually find options under $100, the easiest way is to trade cheaper options on cheaper stocks. Now, a lot of the times we run to large market cap stocks because, it makes sense. Options are going to gain value when stocks have price movement. And these popular stocks, they usually have larger price movements, but they aren't the only option for your options. So you can also get great profits trading options on cheaper stocks. Now, I know this sounds too good to be true, but it's not. And I really want to emphasize the difference between cheap options and low cost options. Cheap options are just what they sound like. Low value, they have little probability of being profitable by their expiration date. That's why they're priced the way that they are. You get what you pay for. Low priced options, on the other hand, are good options that are currently undervalued. And we want to look for quality, low priced options. Let me show you what I mean. A benefit of low priced options is that they usually generate higher percent returns than higher priced options. So for example, in my option trading group, I called out a put option on TQQQ. Okay, so at the time it was trading at $21 and the contract cost me a little over $50. So the premium was about 0.60. Okay, and at the same time, I also opened an SPY put, and that cost about $400 per contract. So we closed TQQQ at different profit targets, and we took profits at 18% and also at 65%. On SPY, we closed at 20% and 45% profits. And those are still good. They were both profitable, but you can see the magnitude that the smaller options can provide. So, don't let the low cost fool you. They still bite back. Now, you can find these undervalued options in a few different ways, but one important thing when using options is the option implied volatility. Now, implied volatility is the expected volatility of a stock during the lifespan of the option. Think about option implied volatility like a mixture of supply, demand, and expectations. So when the stock market expects more, or the demand for an option, whether that's a call or a put, increases, then the implied volatility is going to increase. When the stock market expects less or demand drops for an option, then the implied volatility is going to decrease. Implied volatility is important when you're trading low price options because this is used to gauge how high or low priced an options premium is going to be. So a rule of thumb that you can think of is options with higher implied volatility usually have higher premium values than options with low implied volatility. So if we're just doing calls and puts, then you want to look for implied volatility that's lower than 50 getting into the position. You can create a watch list of a few stocks that you like to keep track of and that have really good low price options. But right here is a list of the top stocks to trade options with. These are the stocks that have the highest volume, and they usually have tighter bid and ask spreads, okay? Make sure you check out this video on the bid and ask spread of options and stocks. Another way that's even easier, you can literally just create screeners and find the perfect lower price stocks for your options at any level. So this is Thinkorswim right here, and you can see that we're in our scanner. Okay, so this is the scan. So let's say, for example, you want to trade stocks that have a volume of at least 500,000. I really say a million, but you can say 500,000. The last price, so you can have a minimum of $5 for the stock and a maximum of maybe $2 or $100. So up here in the scan in, you want to make sure this is set to all optionable. So you're going to go to category, come down here to all optionable. And then this is going to actually be information that you can put in for the option position. So maximum price for the option. The maximum I have here is 1.1. So this is only going to show us options with a 1 premium, or that are going to cost max $100. And you can leave it like that, but you can also add things on the open interest, the volume, days to expiration. And there's other things that you can put, different indicators for the chart, moving average crossovers, you know, candlestick patterns, everything. So you can literally build a screener to find exactly what you need at that time. It just takes a little bit of preparation, but once you build it, it's done data. And let's just scan it and see what we have. Okay, so this is a list, and with this scanner, these are all of the options that come up, okay? So it's not really that many. We only have about 200. So this is just one way that you can use scanners. With this strategy, we want to focus on smaller stocks with high profit potential. Also buy options with higher delta. Now remember in that TQQQ example, it had a pretty high delta around 0.6. So that basically means we were getting $60 in profits for each dollar change in the actual stock. Let's say if you were looking at Tesla for similar priced options around $60, then you would either have to pick an option that had a much closer expiration date, and you already know those are going to be a lot more risky and have higher time decay, or you would have to pick an option very much so out of the money, and that's going to have a delta that literally has little to no value. You would get returns. I'm not saying you would make money with it. It's just you would have a smaller profit margin with that position. So essentially less profits for a similar price option contract. And lastly, you can do one of my favorite option trading strategies, and that's going to be opening spreads or iron condors. Now for these strategies, you're going to need to have an option trading level of at least 3 in your brokerage account, so make sure that you already have that set up. Now there are 2 different types of actual spreads: debit spreads and credit spreads. And if you aren't familiar with those, I have 2 videos on those that I'm going to link down below so you can get an in-depth idea of how to trade with them, what they are and how to trade them. But just a brief review. A debit spread is where you're going to buy a high premium option and sell a lower premium option, and both are either going to be a call or a put on the same stock, same expiration date. They're just going to have different strike prices, okay? And so those prices are going to cancel out. It's going to be a debit, but you're basically going to be paying less to get into that position. Now a credit spread is where you're going to sell a high premium option and buy a lower premium option, both either a call or a put, same expiration date, different strike prices. And with these price differences, there's going to be a difference between the options that you sell and you buy. The one that you sell is going to be more expensive, so you're going to have a little bit left over that you're going to get to keep, making it an overall credit. And this one, you're just going to be profitable as long as your options expire worthless. So you really want those to expire out of the money. Look for lower delta on this one. And for the iron condors, they have a similar structure to credit spreads. It's just that you're going to be placing 2 credit spreads at the same time. Okay, so I know it sounds like a lot, but it's really not. It's really exciting once you get into it. So I'll also leave a link to that video on doing iron condors below as well. Okay, so that wraps up this video, but make sure that you check out this quick Q&A about stocks and options right here. So it's a part 1 and part 2, and these are all questions from you guys, and we have some pretty interesting ones. Okay, make sure you check out both of these videos, the part 1 and 2, and I'll see you guys on the next video. Bye.